So I think we can start. So good afternoon to everybody. I'm very happy to welcome all of you on the second, let's say, event where we have John Feld presenting the Financial Stability Review reports from the ECB. Let me just introduce John, that is the Deputy Director General for Macroprudential Policy and Financial Stability in the European Central Bank. And he's also chair or co-chair of several international working groups, including the Eurosystem Macroprudential Policy Group, the Instruments Working Group, the European Systemic Risk Board, the European Systemic Risk Board Task Force on Stress Testing, and then he's also, member of the ECB Financial Stability Committee, ESRB Advisory Technical Committee, and so on. But clearly, we are very curious to know, what are the news that is able to bring out of these Financial Stability Review reports. So I'm leaving the floor now to John to introduce us to the main result of this analysis, and then we will open up to questions. So I'm already suggesting to all of you that are interested to ask questions to John, just to start to write on the Q&A, let's say, part of the of Zoom. And after his presentation, I will start, to ask to him questions based on your suggestion. So John, the floor is yours.
Okay, thanks a lot, Loriana. Thanks a lot for the introduction, and also thanks for inviting me back to SAFE to present the latest issue of the Financial Stability Review. If there is a next time, I really hope it can be a face-to-face meeting, also with the many colleagues that were involved in preparing the review. I don't know if you know it, but it's a short walk from my home office up to your campus. So we published our FSR on the 17th of November, and since then there has been financial stability relevant news, news of a new Omicron variant of the COVID-19 virus. On Friday, financial markets reacted violently, I would say, to the revelation that this variant has around 50 mutations compared to the original Wuhan strain, raising fears that it would prove resistant to existing vaccines. Now, that seems to have led to fears that it would prove resistant to existing vaccines, but also to a worst case scenario, reverting back to square one. But the major vaccine producers are already mapping the virus and are saying that a modified vaccine, if needed, could be ready within 100 days. So time will tell whether this will prove to be just a setback. And in any case, my hope is that of the graphic on this cover slide will become clearer as we go through the presentation. But to give a hint, in this issue, we try to look beyond the short term and towards the medium term in making our financial stability assessment. Now, we do this because some trade-offs, especially policy trade-offs, have led to a tilting of the financial stability risks as the economy and the financial system have adapted to the ongoing pandemic. Now, before I begin, I should also say that with 5 chapters, 9 boxes, and 3 special features, my presentation will be necessarily selective, focusing on the main. So turning to these main messages, first and foremost, the FSR brings both good news and bad news for the financial stability assessment. So the good news is that pandemic-related risks appear to be receding, with corporates, sovereigns, and banks all avoiding tail risk outcomes. So you could say that the resilience of the financial system has been tested, and its core parts have proven able to absorb the initial impact of the COVID-19 shock. However, the bad news is that apart from the shock induced by the pandemic, protracted supply-side disruptions and soaring energy prices are posing risks for both the inflation and the economic growth outlooks. Now, if this persists, it could yet prove particularly challenging for financial stability. At the same time, vulnerabilities are building in property markets. And we continue to see signs of stretch in financial markets more generally. Non-banks, I think I mentioned it last time, especially investment funds, appear to be disproportionately exposed to many of the attendant risks. Now, how the good and the bad news translates into our financial stability assessment is, as I mentioned at the start, through a tilting of the time profile of sources of risk and vulnerabilities from the short to the medium term. Now you can see on the left that a range of short-term indicators of financial system stress have materially declined, some of them to 10-year lows. For instance, just to pick one of them, the probability of simultaneous default of 2 or more large euro area banks over the next year is now less than 5%. And that's the lowest level, the blue line, that we have seen since 2011, so in 10 years. Of near-term sources of systemic risk is undoubtedly due to the broadening of the economic recovery, especially as seen on the middle chart, the recovery of value added in those countries and those economic sectors that were most affected by the pandemic. So that's the red and the blue lines on that chart. So after the divergence that we saw, recovery, we are now getting some convergence. But we also know that one of the legacies of the Great Lockdown has been an increase of private sector debt, as well as a surge of house prices. And these have driven an upturn of our medium-term systemic risk indicator, and that's shown there on the right, together with its decomposition. You can see the role that bank credit and house prices, the house price to income ratio is playing in that upturn. Now, turning to the next slide, I already mentioned the risks posed by protracted supply-side disruptions and soaring energy prices. So the left chart here shows that the services sectors are mostly affected by labor shortages, while manufacturing is mostly affected by shortages of materials. Now, this together with the broad-based increase of commodity prices, especially of natural gas, oil and coal, could, we think, weigh on the economic recovery. It's a risk. Now, while it's clearly not the ECB scenario, if inflation were to rise by more than expected and if growth expectations were disappointed, that could pose new challenges for financial stability, especially if it were to widen the gap between interest rates and growth and thereby threaten debt sustainability. That said, we have not so far seen much evidence of debt sustainability challenges in the corporate sector. Second quarter profit figures for euro area firms were strong. In fact, they were just 2% off pre-pandemic levels, and 2/3 of euro Stoxx firms reported earnings that beat analyst expectations. Realized default rates in the corporate sector have also been coming down, and that's the subject of the chart on the left. And as you can see, since the start of the pandemic, not only have realized defaults been consistently lower than Moody's baseline expectations, so that's the yellow whiskers on this chart. So the chart is always showing the actual development against the scenarios of Moody's at different points in time. And you can see how the actual has performed against those scenarios. And so, I mean, looking at the yellow whiskers, the outcomes have come in lower than they have come in lower than baseline expectations, but even lower than the most optimistic scenarios, the green whiskers, which Moody's had. Now, these much better than feared outcomes are, of course, thanks to all of the support measures, which have arguably been more effective than might have been initially expected. Now, that said, some are particularly hard hit and they continue to struggle. The chart on the right has a somewhat Darwinian undertone, as it's showing bankruptcy declarations together with new business registrations. So, in a way, births and deaths of firms. And it's clear that the accommodation and food services sector down in this quadrant have been scarred by the pandemic. Births are not replacing deaths. And looking ahead, we see a risk that corporate insolvencies could rise due to a backlog of unresolved bankruptcy cases and a gradual phasing out of policy support measures, but even less than we would have been fearing in the early stages of the pandemic. Now, turning to sovereign debt markets, we've seen spreads for lower rated sovereigns fall over the last 18 months, and governments have taken advantage of this by issuing longer term debt at very low rates. When we look at sovereign bank and sovereign corporate CDS pairings over time, we see them moving in a southwesterly direction over the last year, as you can see there on the left. So there is a separate line for the nexus of sovereign bank, and there's a separate line for the nexus of sovereign corporate. And that would suggest I mean, the direction that those pairings have gone in would suggest that the nexus between sovereigns, banks, and corporates is currently more virtuous than it is vicious. Now, that said, the level of sovereign debt in the euro area can't be ignored. It's nearly 100% of euro area GDP on aggregate, and much higher for some countries. The average for highly indebted countries is the first data point on the chart on the right, and the countries that are aggregated to come up with those figures are listed in the note at the bottom. And the FSR includes a box that considers debt sustainability under a number of different scenarios for interest rates versus growth. I can't go through them in detail, but here, even using the baseline forecast, so that's again, it's a continuation of the blue line. It will take, as you can see there, a decade before so higher debt countries are back to pre-pandemic levels. And a number of scenarios that are shown here, they're all described in the box, suggest more challenging paths for debt to GDP, especially if the interest rate growth differential were to turn positive. And it cannot be excluded that some of them, should they materialize, could send those CS pairings that were on the left-hand chart in a more northeasterly direction. So now going to the banks, I already showed at the start that systemic risk has faded, and it's faded for the banking system, and an important reason for this is the containment of NPLs. At the same time, large waves of losses on corporate loans seem less likely to materialize now than we had expected even 6 months ago. And then despite the pandemic, banks were able to sell their NPLs through the whole episode, and the result is that NPLs have fallen to 2.4% on aggregate for the euro area as a whole. Now, that is in fact lower than before the sovereign debt crisis, and we expect this trend to continue. We've looked at recent patterns of loan performance versus economic growth, and when we combine these with ECB staff economic projections, NPL ratios continue declining at a moderate pace, as you can see there on the left chart, which is showing ranges. Now, that said, the chart also shows the ranges are country and sector ranges. And if you look at the top of the range, you can see that for some sectors in some countries, NPL ratios could still rise. So combination sectors and so on that we had in the previous chart. But the key point here is that we don't expect a broad-based rise in NPLs. Now, as for bank profitability, trading income has improved, reflecting on the back of very strong financial markets for much of this year. And while core interest income remains weak, it has stabilized, as you can see there on the middle chart. And that has helped lift the median euro area bank return on equity more or less back to pre-pandemic levels. But in profitability terms, there's also an international comparison there. Euro area banks remain at the bottom of the class in comparison to advanced economy peers. There's still a structural profitability problem in the euro area, which is going to be a challenge that the sector will be facing going forward. Now, after dropping by more than 40% in the early stages of the pandemic, euro area bank stock prices have recovered more or less back to where they were early last year, even taking account of the plunge that we saw of bank stock prices on Friday. And the same is true of price book ratios that are shown there on the chart. Now, apart from the improved economic outlook, we've learned from our regular discussions, market intelligence, that the lifting of restrictions on dividends and the results of the EBA banking sector stress test in the summer led to expectations of a bumper year, not only for dividend payments, but also for equity buybacks. And one indication that markets appear to be believing that banks will be returning equity to shareholders is the positive correlation, admittedly weak since June, that we see between individual bank share price changes and the level of bank capital ratios that existed at the start of the period, which is shown there on the right. So you can see that banks with higher capital ratios had larger increases in their stock price in period recovery. Now, shifting to commercial property, the pandemic undoubtedly imposed considerable stress on this sector, especially in the retail segment, but also for office properties. Now, while the proportion of respondents to a survey on commercial real estate sentiment that considers the market to be in a downturn has been shrinking. So that's the green area on the chart on the left. The middle chart shows that the retail and office segments have not yet reached their trough. Now, that's especially true, as you can see on the chart, for non-prime properties. And the outlook for commercial property, of course, is not helped by other structural factors such as the shift to shopping and also the shift to working from home. Now, that said, it shouldn't be forgotten that the scenario that was calibrated for the EBA stress test this summer contained very severe assumptions for commercial real estate. In that scenario, commercial real estate property prices were dropping by 5%. Now, that's over a 3-year period. But the fact that banks proved overall resilient to that scenario would suggest that the vulnerabilities lie elsewhere. So, I mean, we've made an attempt to map the exposures, and the chart on the right gives figures for cumulative purchases of commercial real estate between 2015 and 2019. So all of the purchases of all of the real estate, what financial sectors were exposed to that. And it shows that half of the exposures are actually outside the euro area, so investment funds in other countries. And of the half remaining, half of that is held by euro area funds. So that is where, within the euro area financial system, the greatest exposures seem to be seen, and the greatest vulnerabilities. Now, turning to residential real estate. Now, this is where we have probably made the biggest tonal shift in this issue of the FSR. In past issues, we have been attempting to explain, we've covered how we think how demand for housing has remained buoyant throughout the pandemic, thanks to a number of factors, both on the demand side and on the supply side: protected employment and incomes, higher savings, easy financing conditions, etc. On the demand side, just simply that less houses were being built, at least in the early stages of the pandemic. And the result has been that euro area house prices rose by 7.3% year on year in the second quarter of this year. And that's the fastest pace of house price growth at the level of the euro area as a whole that we have seen since 2005. Now, while mortgage credit growth has not yet reached the levels observed before the financial crisis, you can see there on the chart that it did grow by over 5%. And that's, of course, those are the averages for the euro area as a whole. And in some countries, of course, the figures are much larger than that. Now, we have a box in the FSR which shares recent developments with the last big housing boom and bust a decade ago. And the conclusion of the analysis is that we aren't at the extremes yet that we saw then. But I mean, the dynamics don't look good, and some of the features are getting close. And so, and one area that we're trying to get clarity on to get trends in lending standards. Now, the data gaps here are large. But I mean, we've made an attempt. We did it using data on securitized loans, the mortgages that go into mortgage-backed securities, and we've also corroborated that with surveys. And we see a notable increase in high loan-to-income and high loan-to-value mortgages. You can see that there on the middle chart, which is showing. Well, it's showing the aggregate, and it's showing the percentiles, so the almost the extremes of the ranges. Of course, on the loan-to-income side, there is some mitigation of the direct risk because actual debt servicing costs are very low, as you can see there on the right across all of the countries. But if financial history has taught us anything, I think it has taught us that signs of easing credit standards in mortgage markets have often been a harbinger of exuberance, and so warrant, at the very minimum, close monitoring going forward. Now, on financial markets, as euro area economic data surprises turned negative in the summer, you can see there on the left that real long-term bond yields fell, and they fell to all-time lows. Inflation expectations rose. Now, this pattern isn't unique to the euro area. We see it in many advanced economies, and it seems to be largely symptomatic of a supply-side shock to the economy. And it doesn't seem to have halted the search for yield that we've been warning about in the past several issues of the FSR. If anything, exuberance has continued. We took out a summary measure here. It's return deviations from long-term averages for a broad basket of global financial assets. And you can see there that it's reached almost 2 standard deviations, and at the highest level that is seen there on the chart. And of course, search for yield, very high in corporate bond markets and very high price earnings ratios in equity markets. And this is also true. It's more so for the US, but it's also true in the euro area. And in this environment, alternative assets such as Bitcoin and various types of stablecoin have also been beneficiaries. And as you can see on the right, since the start of the market capitalization collectively of the largest stablecoins has followed basically an exponential curve from just a few billions at the outbreak of the pandemic to almost 120 billion. So the growth and explosion in the market to 120 billion in a matter of just 20 months. Now, we dedicated a box in the FSR to the risks posed to speculative holders and to the wider market from the growing large pools of assets that they use to back their tokens. But the risks here are similar to the ones with investment funds, money market funds, to be more specific. Now, moving to the next slide, non-banks. This is the sector that I said already that is most exposed to the exuberance in financial markets. Now, we've been concerned for some time about the growing exposure of the sector to credit, duration, and liquidity risk. The left chart here attempts to capture all 3 of these vulnerabilities. So all 3 are, and not only have they continued rising, but they're even larger now than they were before the pandemic. And then at the same time, as you can see on the right-hand side, holdings of BBB and sub-investment grade bonds now represent more than 54% of investment fund portfolios. Now, while that means that the sector has become an important source of real finance, I mean, the fact that the sector has low liquidity buffers mean that source of finance could yet prove very fragile. Also, as shown on the right, reflecting the buildup of duration risk, we also see increasing sensitivity of investment fund portfolios to interest rate rises. Now, while this is also true for insurance and pension funds, don't forget that they're usually hedged on the liability side, pensions and life insurance liabilities, and often with longer maturities than the assets on the other side of the balance sheet. But investment funds don't have that natural hedge. So of course, it's the investors then that will be exposed ultimately to that risk. Now, moving, I'm getting close to the end, Loriana, and moving to the policy implications. You recall that in our last issue, we had already started making a case for gradually exiting from measures that were providing short-term support to banks and especially corporate lending. Since then, we've seen loan moratoria expire. The take-up of public guarantees on loans has been modest. Special fiscal supports have become more targeted as business activity has resumed and corporate turnover recovered. Now, this time we take account of the tilting of the time profile of risks, underscoring that the financial sector and macroprudential measures can continue the pivot of focus from near-term support towards addressing medium-term vulnerabilities. And we think a gradual approach is still justified, not least given the headwinds to the economic recovery. And for now, we focus mostly on real estate risks and the counter-cyclical capital buffer. We also place some emphasis on where the policy framework needs strengthening. On cyclical policies, I would focus on residential real estate, consistent with our assessment that vulnerabilities are rising in several countries, and with signs that lending standards appear to be weakened. We think that there's scope for action here. Some countries, by the way, have adopted measures already, either capital measures that would enhance banks' loss absorption capacity, or more direct borrower-based policies that seek to manage the risks in mortgage lending. That said, some countries do have elevated risk levels. Some of those countries received warnings from the ESRB or recommendations just before the pandemic, and they either still have no measure active or they have room for tightening. Turning to this is the third last slide. I mentioned that misaligned asset prices have been a cause for concern from a financial stability perspective for some time. This is especially so for the investment fund sector, which, as I said, is heavily exposed towards liquidity, credit, and duration risk. And we've repeatedly laid out in the FSR the need to fill gaps in the framework for investment funds. And this is finally on policy. This is my penultimate slide as a reminder. We underscore that long-term resilience would still be further enhanced by progress on a number of other policy areas. We repeatedly advocate for the implementation of the last leg of the Basel III reforms and the completion of the banking union. We're also emphasizing and doing it regularly now, the urgency around efforts to support an orderly climate transition, where from a financial stability perspective, action is needed on disclosures and standards, as well as on monitoring. So concluding with this slide, and I'd like to thank Inca Cordero, a colleague of mine at the ECB, for this visual summary of the FSR. We see a tilting of the time profile of risks. Now, although it has not been without costs, the fiscal, monetary and prudential policy responses, as I said, prevented the health crisis from resulting in a financial one. But it has meant that some vulnerabilities in the macro financial environment are now greater than they were before, and new ones have emerged as well. And we also have to be mindful of the evolution of the pandemic. I think last Friday was a wake-up call that we are not out of the woods. So given the tilting of the time profile of risks, we're arguing for a gradual pivot from focus on near-term support towards measures aimed at addressing these vulnerabilities, including gradual increases in counter-cyclical capital buffers where economic and banking sector outlooks are favorable. And we raise in particular the case for more policy action on real estate markets. So let me stop there.
So thank you very much, John. Well, this is very nice as a representation and a summary of your presentation as well. I'm clearly suggesting for having a question, but there is already one. So let me start with the one from the audience, but clearly then, I have several as well. So the first question is, how confident are you to capture sufficient evidence in terms of facts and figures to cast a judgment on non-banks? By definition, the lack of regulation translates into a lack of knowledge. Could any tyranny of monetary policy generate a broad-based panic without central banks knowing where to look? So in some sense, the point that he's making, I think, is that they are not so much regulated. So you don't know really. You don't have the number regarding them. And so how can you do any type of analysis and forecast?
Well, I mean, we do data collections at the ECB. I mean, we have data, we have rich data on investment funds, on their balance sheets, what's in their balance sheets. And we also have very good data on holdings of securities for the euro area as a whole. And those statistics are, granular enough that we know exactly who is holding different securities. So we have more data than you might think. So
pretty much, yeah. So it means that the trend that they are going versus, triple B, let's say, investment in liquid bonds is based on pretty much an analysis done easing by easing for the bonds held by this. Let's say money market funds. That's my understanding.
It's database.
Yeah. So, related to this point, I have a question. Given this evidence that we have this fragility coming from the non-bank financial institutions that are holding pretty much corporate bonds that are quite liquid, and clearly, given the situation that we have in Europe, that we don't have really a very liquid corporate bond market, even if we are doing all this effort versus the evolution of having a proper capital market union. And if you're thinking to MiFID II, there was all this push for transparency. After 3 years, it's true that we have the COVID. What is your evaluation in terms of the corporate bond market? Because if these money market funds are holding these bonds that are illiquid, is either because there are not so many other liquid bonds in the market, or are they actually choosing on purpose these illiquid bonds?
Right. So, I mean, I haven't looked at a recent analysis on that, Loriana, so I'm going to have to speak from memory on the last time I looked. I mean, we certainly were seeing improvement in liquidity, but I think your question, it's interesting what you said. I mean, I think one of the trends that we saw as part for Hunt for Yield was also migration of exposures into less liquid liquid assets, because of course they pay a higher liquidity premium to the holder, and so you get a slightly higher return. And I think we were seeing some evidence on that, but I'm not able to tell you about the most recent figures. I mean, I would suspect, yeah, I mean, there was some liquidity. There were some liquidity problems in March 2020, but I mean, those were, of course, quickly evaporated. But I think it was partly, of course, thanks to the actions that the ECB took in the corporate bond market as well. So, but in any case, yeah, I mean, the market recovered, and yeah, bid-ask spreads normalized, and all of that. And I must say, I kind of wasn't looking at it much closely after that.
So
yeah,
we have another question that is, do you think firms could suffer a debt overhang after the large increase in debt during the COVID crisis and also some increase before the crisis? Can this affect banks and non-banks and the economy by a feedback effect?
So, I mean, I think my answer to that is yes and no. I mean, I think I might have had it in my presentation last time. I mean, we haven't seen at the aggregate level, a concerning rise in corporate sector indebtedness. But if you look by sector, I mean, there are some sectors, where, I don't know, cash flows, revenues completely dried up, and firms had to find a stopgap, and it was often borrowing from banks to do it. So, I mean, I think, and it was a bit implicit also in the chart that I showed on our projections for NPLs, and maybe also the chart that I had on my Darwinian chart, as I call it, that was, yeah, I mean, showing that, that the impacts across different economic sectors have been very differentiated. And then, I mean, for banks, I mean, so far, I mean, of course, I mean, it's difficult to speak with any certainty here. We're still trying to understand the transmission of this shock, and not only the transmission, but also, the dampening effects of the reports and how long that is going to last. I mean, I think we had been expecting, I think maybe we discussed this last time, Loriana, that, I mean, maybe we just have prolonged the period before we see a rise in NPLs, but certainly on the horizon that I was showing on that chart, which was out 3 years, we're not really seeing a big increase in our problems for banks coming from deteriorating credit quality.
Yeah, well, the record is very large, and you have long, by the way. You have also a focus on non-performing loans, and in some sense, some way how to, in some sense, to handle them via creditor coordination. Clearly, you don't have the time to, to elaborate on this on your presentation, but I think it would be nice if you can elaborate a little bit. So what is the idea behind this creditor coordinator? What are the suggestions that you are, in some sense, making in this report for how to handle previous crisis, previous COVID pandemic non-performing loans, and the one that clearly the pandemic will generate, now that in some sense the public support is shading through time?
I'm kind of glad you asked me the question, Loriana, because as you know, I mean, I've worked a bit on NPLs for years, and this was an issue that we were kind of looking for, when the opportunity would come to write about this. I think it's, I think the market for the NPLs have a number of well-known market failures, the market for lemons and so on, and we know other issues about the structure of the market from the investor side. But one market failure that we kind of felt sometimes doesn't get sufficient airtime is the one of creditor coordination. And I mean, we saw this in countries that went through financial crisis.
Can you please elaborate it a little bit more? So can you please elaborate it a little bit more?
Yeah, so this
what you have in mind is that,
so I mean, to make it very simple, I mean, this is basically a situation where, say, for example, you have a commercial property developer, and that developer has loans with a number of different banks, and then it gets into trouble, and then it can behave strategically. It can default on, say it's 4 banks, it could default on 3 of them and continue its relationship with the other. So it doesn't have that constraint once it has more than one bank, there's a kind of it's a game theoretic thing, and it could tactically play between them. And of course, and what that does is it reduces the value of the loan, the expected value of, the net present value of the total amount of outstanding NPL. So through creditor coordination, sharing of information, or even consolidation of the exposure into a single consolidator, there's a number of different ways of doing it. Bad banks do it that way, consolidating into a single. In the end, consolidating all of the exposures. Let's say the 4 banks get transferred into a bad bank. But you could also do it through transactions platforms, and I mean we put forward some new ideas in that paper. We saw that the issue might be a little bit more relevant now, that there might be some, and we got some statistics that we didn't have before, where we could actually document the importance of the issue, and that you do find that there are. It's not often that a corporate is borrowing from a single bank.
So you think that clearly this will, in some sense, help to find a good agreement between the buyer and the seller of these non-performing loans by having a sort of creditor coordination. That's your
yeah. Point. I mean, I guess our interest from a financial stability perspective has always been, I mean, we're interested that the seller, which is usually a bank, gets the highest possible value for the NPL, because if it, I mean, that is financial stability relevant. If banks are not getting good prices for their NPLs, it will be eroding their capital, and so we think it's a financial stability enhancing measure.
Okay, good. So now I'm changing a little bit the focus. You spent really just 1 or 2 minutes, but maybe it was not enough, about stablecoin and how the use of stablecoin can create some problem in terms of financial stability, and why stablecoins and not Bitcoin or other cryptocurrencies. So can you please maybe elaborate a little bit more on this aspect?
Yeah, well, I mean, just to elaborate the difference between crypto asset, the Bitcoin type asset, and the stablecoin. I mean, the Bitcoin it's not backed by anything. There's no cash flow, actually, there's nothing, but it has value, and I guess we could spend a long time discussing why it has value, but stable coins they're backed, they're tokens that essentially maintain a stable value, like a true currency, and they do it by backing it with assets. Usually short-term money market type instruments, and of course what it means is that the balance sheet for stablecoin, which looks similar to the balance sheet of a money market fund, actually close to a constant net asset value money market fund, where you're promising that you're always going to deliver, pay back at par. And there there's a liquidity mismatch potentially on the balance sheet of the institution. So if people want their money back, if they want to exchange the Bitcoin back, the stable coin back for currency, in certain situations, if the stable coin provider doesn't have the liquidity, it may be forced to sell assets in the same way that we have with other types of funds. So that's, I think, one of the important reasons. And the difference as well, of course, is that they're not generally regulated. I mean, they're more or less unregulated market funds.
Yeah. So clearly, I'm inviting people to ask questions, but given that I still have some option, I'm clearly trying to use my option to ask you other questions. One, at the beginning, you start in your presentation talking about sovereign risk and inflation. That I think is, let's say, a very delicate aspect that clearly is relevant for Europe and also for financial stability on top of monetary policy. So clearly, the fact that interest rates are increasing due to inflation. How much will, in a sense, on one side, they might benefit the large stock of bonds issued by the different states in this period. So inflation is not clear how is having really a strict relationship with sovereign risk by increasing or reducing it, and how this will create or not financial stability or financial instability.
Yeah, I mean, actually, we don't have a fully fledged analysis this time on all the channels that through which inflation can have an impact, how it can have an impact on financial stability. But I agree with you, Loriana. It's not straightforward because there are many channels through which there can be positive effects. I mean, of course, inflation in the end, it results in a transfer from borrowers. In a transfer from savers to borrowers. I think some of us, my father likes to tell me about how he did very well borrowing in the 70s to buy, he was able to buy, yeah, maybe a nicer, he was a bit ambitious. He understood what it meant for his repayments. And so, it's good for them, but for savers, it's a different story. That's not, of course, a financial stability matter. I think it's more about, one source potentially always of alarm is if you have a sudden movement in financial markets because of a sea change, tectonic plate shift in exchange or something, and that can feed through. I think I used to work in the monetary policy area of the ECB, and I used to be well versed in the mantra of the benefits of price stability, and of course one of them was always the inflation risk premium, and when the inflation, that's something that you have to add to the real interest rate, and of course that's a kind of that's a deadweight loss in the economy, isn't it? I've forgotten the terminology, but I think you call it a deadweight, and that is ultimately impairs economic performance and so on. And if it rises, that would affect debt sustainability. So the O minus G in most of the debt sustainability equations, you're going to be subtracting the same inflation number from both the O and the G. But if you have an inflation risk premium, that's going to raise the real rate, and that changes all of the arithmetic, and then you can actually
some negative effect on sovereign risk.
Negative effect, and this is one of the things, and that's a bit what's in some of the simulations that we were showing in the box.
Yeah, so this is coming out from the graph that you showed to us, that is reducing sovereign risk in the short term, but is increasing it in the long term. So that was exactly what, regarding to this, you were also touching in the report the role of financial stability for ECB monetary policy. Can you please elaborate it a little bit?
I think it was communicated as part of the package of announcements on the review of the monetary policy strategy, that greater account would be taken of financial stability considerations in the overall discussions. We're working on operationalizing that now. It started a good dialogue between the financial stability area and the ECB policy area. But I don't have any concrete example to give at this point in time, bar that work is underway. I guess, as it is embedded into the discussions, into the framework, into the deliberate and the communication, I think I put to say more. And I'm really saying that genuinely, because we haven't really, it's just started.
Yeah. So you end your review talking about climate change and the climate change transition, and how this can create vulnerability. And it seems that you are using this fantastic word that is this orderly climate transition. But really, what does it mean? We need to move to a transition, because if we are not moving and we are not creating some problem now, we will have even bigger problem in the future. So we need to do this transition. This can create problem to the financial system, and we know, because your simulation shows increasing tail risk. But on the other side, what does really mean an orderly climate transition?
I mean, I think it's the least cost transition. I mean, and you're quite right what you said, Loriana. I mean, the cost could be enormous if action is not taken early. And there's only so much that can be done on the financial sector side, by the way. I mean, the financial sector can price the risk. It has the job of allocating capital in the economy, the distribution of funds from savers to investors and so on, and doing that in an efficient way, pricing the risks accurately. I mean, we've identified, some of the obvious shortcomings about, to do that pricing of risk, to assess the risk. More transparency is needed. But it's the usual. I mean, I think it's no different to any other. In a way, it's similar to monitoring credit risk. And what is needed for market analysts, for banks to be able to monitor and price those risks and understand what risks they're taking. But I mean, I guess there's potentially perhaps some non-linearities that don't. Well, I mean, I don't know in the credit risk space. But yeah, I mean, some assets can turn from green to become brown, or stranded assets, or
so pretty much. In your view, the impact on the financial sector is via credit risk. So increasing credit risk for the asset side of the banks, and what you're pushing is that banks start to price it, and eventually, then handle this risk, hedge this risk, or have capital to hold and, in a sense, cover this risk. That's the message that is coming, because sometimes it's not clear what is really the message is coming out from all these fantastic analysis on climate change can create vulnerabilities. Yeah, but then what are the implications? So they are going via the usual instruments. So they're going via the climate, the credit risk models of the banks. They should include it, and then start to learn how to hedge or handle this risk. That's the message, or something else?
No, that's the core of the message. Exactly. I mean, I think that, I mean, I think what the financial sector is not front and center in this. I mean, the policies, the policy toolkit, where the most effective policies are likely to be are not in the financial sector domain, in my view. But the management of risk can certainly play a complementary role to, let's say, a fiscal taxing of carbon and all of this, which is going to change the economics of different sectors, and the viability of sectors and so on. And there's so much that governments can do with tax policy on this, that the financial sector would, of course, respond quickly. I would expect. So I mean, that's. Yeah, but I mean, in terms of, there are issues just about the measurement. I mean, I think we have to get better, ensure that, I mean, people talk about greenwashing, way sellers of securities might package securities that might look like they're green when they're not really green, or they're kind of green, or they're a bit green. So these are the market for lemons issues, aren't they? The transparency issues. And I mean, I think this is incredibly important, because if you don't have that, you're not going to have efficient and effective pricing.
Yeah. So related to this, there is a question: is the ECB interested or involved in the development of the EU mandatory sustainability reporting standards? And will they provide useful information, such as on firm vulnerability and climate risk? So pretty much, how to set up it in a way that can either reduce or increase firm vulnerability and climate risk.
So I'm not able to answer that. I'm going to have to get back to the questioner. on that. I mean, I'm not working directly on the climate issues, but we do have a whole team that is working on climate related matters and a lot of different aspects of them. So I'm happy to pass on. I'm happy to pass on the question. Apologies for that.
Yeah, clearly it seems that there is interest, and for, you know, also when you're doing the next financial stability, it will be nice to know, you know, a little bit more on how, in some sense, you have the regulators creating some issue, maybe by requiring some disclosure that can create problem in terms of credit risk to banks, and how, you know, there is the usual problem of coordination among the different bodies, the regulators, the macroprudential, let's say, bodies, and those that need to supervise the banks and so on. I don't know how much this type of issue has been debated, even at the ESRB, by looking to the different dimension. Maybe this can be also something that it has to be addressed properly. So not just talking about this, you know, orderly climate transition, but try to put the different bodies in the same, let's say, room and try to have a sort of coordination, as is needed for the non-performing loans, is needed also for this type of issue. Yeah, and I think that you can be really the one that push on this direction, given that you are in all these different bodies.
I think, Loriana, of course, the work on the, you know, what I would call the firefighting work on everything to do with the pandemic really absorbed, you know, the time and resources of many people in the financial stability business. But, you know, this is featuring more frequently on the agendas of financial stability bodies, including the ESRB. And yeah, I mean, I have a small thing tomorrow at my general board presentation on climate related issues.
Good. So, you know, I think that our time is over. I would like to thank all the participants. I would like to remind that clearly the registration, you know, will be made available to the participants. Unfortunately, your connection, John, this time was not so good. So, you know, it was sometimes a little bit difficult to hear you, but in any case, we understand the message. Thank you very much. And, you know, clearly, if there will be other questions, we will be happy, you know, to forward them to you. So we are supporting and suggesting to send them to us. And, you know, I think that I need to thank you for your time and being open, you know, to discuss with us the financial stability review. We are always learning a lot from this type of, let's say, event. So thank you very much.
Thank you too, Loriana. It was my pleasure.
Good. Bye-bye.
Bye-bye.